everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy. Gino Barbo. Gino, how's it going?
I'm doing good, Jake. Back in my element, ready to rock and roll on episode 101. Right, Jake?
We missed 100. What kind of guys are we? We suck, man. We got to sit back and appreciate something. Last episode was number 100. We didn't even realize it until today. So What are we doing, Gino?
Well, I want to give a little gift out to people for episode 100.
You're giving a gift?
Yeah, I want to give a little gift. I think it's appropriate. I mean, I can't believe we survived 100 episodes, to be honest with you. I have words of wisdom, right, Jake? We first started out, we didn't know what we were doing. Anyone who wants to start a podcast out, guys, the reason why you start a podcast is not for yourself. The ultimate reason is to serve others. So to think about a podcast or an idea, Jake and I saw that multifamily was underserved. I mean, true multifamily. Like, if you go online, there's very few multifamily podcasts.
Nobody doing multifamily like we do in multifamily.
Well, I wouldn't say that, but there's very few shows. Everyone's doing real estate, fix and flip, all that stuff. So focus on something that you want to serve people and really put your heart and passion into it, and just expect to suck for the first 30 or 40 episodes, right? And it's okay if you suck, because we all have to start somewhere. But it's not where you start, it's where you finish. And hopefully we've got a lot left in the tank. We love doing this. I hope you guys can hear the passion, the energy, and the quality of guests that we have on. We're just getting better and better. The quality of our guests are getting better and better. And we love doing this. So, I mean, if anyone wants to hit us up, leave us a review on the podcast. Shoot me a screen grab. You left a review, and I will send out a free book to anybody doing that. I'd love to do that to you. I'd love to spread the mission and the word. Right, Jake? 100. 100 is a big deal, right? Yeah. Well, I think I want to just say thanks to our listeners, right, Jake?
That's coming out of your draw at the end of the month, though, right? Not mine. I'm just kidding. Hey guys, no, I just want to give a quick shout out before we get started to our sponsor, CrowdStreet. Who knows you don't have to know a guy to find a quality commercial real estate investment opportunity. Learn more at crowdstreet.com/wheelbarrow. And they're giving a free gift today, too. Everybody's giving something today, so this is great. So anyways, let's get started. Today's guest is Hunter Thompson. Hunter is the principal at Cashflow Connections, a real estate consulting firm based out of Los Angeles, California, that helps clients invest outside of the stock market in turnkey real estate investments. Gino, I think we're talking mobile home parks today. I'm not sure. What say you?
I don't know what we're talking. We're talking real estate. Whether it's mobile home parks, it's all the same thing, right, Jake? It's all about that passive income. It's all about that cash flow, bro, right?
The cash flow.
I think we're talking
baby.
Self-storage.
Self-storage. Oh, man, you're killing me. So anyways, hey.
We can talk about mobile homes, too.
We can talk about mobile homes. Okay, so Hunter, welcome to the show. Tell us how you got started. I know you started it in UT. We're in Knoxville, so we're excited to hear about that. Tell us about your jump from Tennessee to LA and how you got into real estate.
Yeah, I mean, I'm born from Memphis and kind of went to college near that home base. And I actually moved out to Los Angeles for the first time in 2007. There was a poker boom really going on right now at that time. The online poker was just taking off. Someone named Chris Moneymaker, who you guys may be familiar with, is kind of a random Joe Schmo that won the main event in the World Series. And so this created a ton of attention to the poker space. And then what ended up happening is that all this money ended up coming. It became somewhat easy or at least profitable to pay attention to the game, look at it as a business, and basically make money off of that. So I had a couple of advantageous months in 2007, thought I was the king of the world, moved to California to play the Commerce Casino, which is where the largest poker room in the world. At the time, it may still be the case. And, played there for the summer, fell out of love of poker, made some money, but it's just, imagine working the worst day job on a grind you couldn't imagine with some of the worst coworkers.
That's not what Dan Bilzerian says. He looks like he's enjoying it, man. Come on.
Yeah. Well, see, that's online. He made a lot of money online. Yeah. Actually, you know what? Most of that's live. But the lifestyle change for me was the difference between playing live and playing online. Online was you got to wake up whenever you wanted. You got to play from home. Going and playing live, playing in a casino all day was, it really was just such a different experience. But so fell out of love of poker, but fell in love with LA. So once I finished school, I came out here immediately. And, to kind of segue into real estate, I graduated right, at the bottom of the market, essentially, and knew there would be I originally started pursuing stocks and bonds and trading. But when I kind of found out what real estate had the capability of doing was really not until 2010. And I've talked about this before, but I think it's just such an incredibly straightforward moment. It was when the European debt crisis was really having a significant effect on the U.S. stock market. And this is essentially when Europe was going through something very similar to the United States in 2008. And what happened was that the capital markets froze up, and it was causing all this volatility in the U.S. markets. And I remember watching CNBC, and they were talking about how if the Greece bond yields remained below 7%, that the S&P 500 was going to be fine. But if the Greece bond yields went below 7%, the S&P 500 was going to collapse. And I just kept thinking, how is this playing any role at all in my financial well-being or my financial future? I've got to completely disassociate with all this stuff, and that's what kind of led me down the path which eventually led me to, pursue real estate full time.
Hunter, I got to give Jake a tip here. You said you play at home, online, whatever. Jake, we was off camera. We were talking about working at home. He could work in his underwear, put some hair gel on. Jake, this is a second career for you,
dude. I'm
bro.
in my underwear right now. You guys just can't see it. All right.
Yeah.
So, Jake, little tip for you, bro.
They're nice.
Hunter,
It's Calvin Klein, man. We're styling here, so don't worry about it. All right.
You talked a little bit about real estate. I mean, tell us about your first deal and what you learned on that first deal.
Yeah, at the time, 2010 or so, there was so many opportunities out there, and I found the most favorable risk-adjusted returns could be found by lending money to real estate flippers in non-volatile markets. So we would lend up to 60% loan to value. Typically, let's say 80% of purchase price or so in a market like Memphis, Tennessee, just doesn't have a lot of track record of volatility. And we would just slap a loan on the property. They would flip it up, and 60% of ARV, meaning that as long as they finish the property, we're really good to go. So $100,000 property, and then if they default, we'll take the property back. We didn't take any of those back, and the rates at the time were pretty favorable. I'm talking 11, 10, 13% in some cases. And that was my first investments, and those are some of the, still to this day, I would do that all day if I could still. The rates have changed, obviously, but those are my first investments.
So how has your investment strategy changed over the last 6 or 7 years?
Yeah, I mean, a lot of it has to do with the fact that I really came to love and realize that it fit my personality best. Just the passive syndicated structure. So I really like investing in syndicated commercial real estate investments with a smaller minimum investment. I'm willing to give up control in exchange for diversification. And that, again, that's a personality test. Some people want to be completely hands-on. For me, I would rather identify a operator that is best in class, invest with them, defer to their expertise, defer to their ability to acquire inexpensive capital, and spend my time doing things that I love, regardless of whether or not that's business or not. Is anyone can say that, but that's the way that I built my portfolio for certain, and I'm happy to do that. Sleep like a baby because I'm extremely diversified in different asset classes.
So let's talk about your buying criteria. What are you looking for? I mean, I always think the sponsor or the operator is the key. The deal is secondary, because if you have a great sponsor but a crappy deal, the sponsor will come through one way or the other. But if you have a marginal sponsor but a decent deal, if that deal craps out, the sponsor's really wary. So other than the sponsor being spot on, and give me some criteria we're looking for in a sponsor also. But dive into the buying criteria, whether it's cash on cash, whether it's the kind of markets you like, and talk a little bit about the sponsors.
Yeah. So from a big picture perspective, I've really been interested for the last 3 years or so in the recession-resistant assets, most notably mobile home parks and self-storage. The reason for this is that the economic climate and the long-term trajectory, in my opinion, it presents an opportunity to invest in products that cater towards where the demand is basically inelastic. So self-storage is a good example of this because of the fact that people use the product more frequently when they are going through some kind of change. And a lot of those changes can be brought on by recessions. So you think about people losing their jobs, layoffs, job changes, kids moving home from college unexpectedly. All of that is more common during recessions, and all of that is likely going to result in people using self-storage as a product. Now, to answer your question specifically, my opinion, the real strategy for self-storage is to buy extremely mismanaged properties and implement value-add strategies with in-place income. So year one cash flow isn't the main concern. What I want to find is a in-place tenant base that is not being where the facility is not being run efficiently. Some of these examples are U-Haul, for example. So there's a lot of properties out there that are in the $5 million range that don't have a relationship with U-Haul. So we'll buy a property based on in-place income. Let's say it's 85% occupied, and we'll call our contact at U-Haul very quickly. They will park 15 to 40 U-Haul trucks on this facility. We rent out those trucks and take a commission for facilitating the transaction. I have personally invested in properties where that one line item has gone from $0 a month to $3,500 a month, which is, if you look at that on a cap rate basis, that's hundreds of thousands of dollars of value added. That's directly to the bottom line. So there's a lot of different strategies when it comes to self-storage that are similar to that. But you got the tenant base, which is not very price sensitive because the gross dollars just isn't that significant. So, for example, if you raise rents by 6%, it may only be $9 a month or so to the tenant. The question then becomes, are they going to take the day off work, hire rental movers, get a rental truck, move down the street, et cetera, just for $9 a month? And the answer overwhelmingly has been no. And that's true throughout the last several decades, but particularly through the 2001 and 2008 recessions. So that'll kind of give you an idea of the buying strategy there.
So this seems like a good opportunity to get people in cheap and then creep them over 2 or 3 years. Is that kind of what you guys do?
Or they're in cheap already, right, Jake?
Yeah.
Exactly. So there's so much, it's comparatively to the other asset classes out there, there's not a lot of transparency in the market in terms of the net dollars spend on a rate basis. So there is properties that are incredibly mismanaged. The industry is very fragmented. So 77% of the business is owned by independent owners or non-REITs. And a lot of these independent owners have one property. They just don't have the capacity to run the property efficiently. And part of that,
those systems. Yep.
Exactly. Yep. Part of that is accurately dictating the price of the market. So we've seen many properties that are 15% under market rent. And then the key there is that you can raise rents very quickly, because not only because of the sticky tenant base, but because of the fact that it's all monthly lease renewals. So you can very quickly, 30, 60, 90 days, turn around a property in terms of rental increases.
So what kind of markets? Because I know down here, I just moved to Florida. Florida has no basements. So it's self-storage is huge down here. Just because of that, there's no space to store stuff. What other markets are you looking at?
Yeah, Florida is a great market. I'd say the Southeast in general is probably my favorite region. The combination of, what you just mentioned is a great point. You also see jobs are solid there. The cost of living is usually lower there. All things kind of point to being able to extend those rents. But also you have demographic issues. Florida is receiving a lot of baby boomers. And when people are entering, quote, retirement with very little savings and are relying on Social Security, you find them downsizing frequently. So again, very likely to be self-storage tenants because they don't want to give up their possessions.
Hunter, let me ask you about deal sourcing. Two of the biggest questions that our students have is, one, where do you start sourcing these deals? And two, where do you find the capital for these deals? So can you elaborate a little bit on that?
So my business is to identify sponsors and then essentially allow investors to invest alongside of us in our sponsors. So our deal flow comes through some best-in-class sponsors. We identify a sponsor that has a solid track record, 10 years plus in the business, more than $100 million of transactions completed, usually taking more than 10 deals full cycle, et cetera. And this is, it sounds like maybe that wouldn't be that competitive of a list. The reality is there's not that many people out there that are going to be able to deliver consistently, and we can identify those people quickly. So to answer your question directly, the deal flow is going to come in conjunction with our sponsors who completely tied into the markets they operate in.
Do you remember the first deal you did, your first self-storage deal?
Yeah, absolutely. It's in Fayetteville, North Carolina, and it is. It looks like it will be quite a screamer. Again, it had very similar to what we exactly look for: underperforming on ancillary income and a consistent paying tenant base. So 75% occupied in a market that's 85% occupied or so. No U-Haul component. No mandatory tenant insurance, which is similar to the U-Haul component. You mandate that all the tenants use tenant insurance, which also covers kind of your liability if something were to go wrong, but more importantly, directly to the bottom line because you get a commission for facilitating it. So that's another $1,500 a month or so, and that property ended up being closer to $2,200 a month. So, you're adding hundreds of thousands of dollars, if not $1 million in value to the property, as well as raising rents. And that property is under contract to be sold. We purchased it for about 6.7. It looks like it's going to be sold for nine plus.
That's
it's going to
awesome.
be quite a deal. Yeah.
So I got to throw this out to Jake. Jake, next phone call we make when we get off the call is we're going to give U-Haul a call and see if they want to do a deal with Jake and Gino with our mom and pops, because on 156 units, we got guys that are constantly moving out. I've got a tenant handbook that for tenants and moving guys. So this might be, for all
Gino,
you
you're going to change
multifamily
the
guys.
game? You're going to start bringing U-Haul into apartments?
You never know. I mean, listen, a lot of them do their own. They do their own self-moving. So I think that's another component for that we have to look at. We've never really looked at it. I was always thinking of getting a truck and actually buying a truck and putting our brand on it. But this, if we can get a little vig on this, Jake, that's the next.
Gino
call.
loves the U-Haul. I'm just going to tell you right now.
I like the key. I think your mindset's right on. The key, like in the latter part of your explanation there, is that this is a model in which you don't have to go through the capital expenditure,
Yep.
and therefore your risk is so. I mean, come on, what's the worst that's going to happen? You either rent the truck or you don't, and that's
right.
the end of it.
Well, what I like about it is you're offering another service. I mean, do our apartments doing this? I don't know if they are or they're not. We have to do a little market research. But, hey, if they can make some money, we can make some money, and the tenant doesn't have to go anywhere to get the truck. I think that's a win-win, right, Jake?
We'll look at it.
So let me ask you, what do you look for in terms of underwriting? Expense ratio, price per unit, any other rules of thumb that you're looking at?
Yeah, absolutely. I mean, first of all, again, because we're sponsor focused, we're looking at the underwriting to make sure it matches up with our expectations. But the reality is we want to first make sure that the sponsor's putting themselves in a position to deliver. And that is really the key. Every time we look at everything, we're just asking the question, are these people being aggressive? Do they want to just get one deal done with us? Or are they trying to build the long-term relationship? And if you know what you're looking for, you can figure that out pretty quickly. I'd say that the expense ratio is usually we look for something close to 40%, depending on the vintage of the property. That's a good solid number. And also it's slightly less than some of the other asset classes because you're not really providing that much. We look for A-class properties, or we want to buy B-class properties, turn them into A-class properties typically. But, 40% expense ratio, given the fact that, you're really not providing that much. It's basically concrete and maybe a light bulb. So that'll kind of give you an idea there. In terms of rental increases, this is something that is kind of interesting. We typically underwrite somewhere between 4 to 6% on an annual basis. Some people may see that and think that's aggressive, but historically speaking, that's very conservative. It'll be, it's pretty surprising how conservative those numbers are. And, over the long term, that can make a significant difference on your cash return, because we have seen a stratification take place between, or a delta take place between expense increases and rental increases. Most of the time when you're looking at underwriting, you want to see no difference, right? If you're trying to be very conservative, you want to see expense increases going by 3%, rental increase going in lockstep with that. But we have seen 6% rental increases take place twice a year in certain properties that we're in, which is pretty incredible from an investor's perspective.
What's your expected hold period on these properties?
We look for 7 to 10 years. And the reason for this is that, again, we want to be conservative. And I think that the key is that there's really important parts of buying and selling real estate. So it's buying the property good and then implementing the value add strategy and then selling during favorable market timing. And the last one is very challenging to control, right? So we want to use a 7 to 10 year time horizon because we think that's enough time for us to buy, implement the strategy. If something were to go really wrong, we can usually weather that storm because of the recession resistant component and then sell later when the market is kind of turned around or the capital markets have turned around.
Do you employ property management, and how do you find property management for these assets?
Yes, and this is absolutely critical. So we're looking for, sponsors which are vertically integrated with management companies. It's pretty much the standard in the business, and it's pretty much mandatory because of the complexities of the asset class. Now, based on what I've said, you said we're not really providing that much. Well, the key is that the the self-storage asset class operates much more like a business than a commercial real estate transaction. There's so many line items that can be tweaked, and this is where the opportunity really is in the asset class, because the discrepancy between a mom and pop operator and a best-in-class operator becomes very significant. So it's all about the management. So again, we work with sponsors that have management on site, and also regional managers typically if they have economies of scale in a particular market.
So why don't you dive into some of those differences, because I think that'd be important for people to understand. Because me looking at it in the peripheral vision, I know you can have ATMs where they can actually do it themselves. Log in themselves. You have gate, you have software, you have security, you have all these different facets that if you really want to have a top-notch asset going there's a lot of it. So if you could just dive into some of those differences between a mom and pop and an A-class operator.
Absolutely. So I'd say that the first two differences are the most basic that we look for, the U-Haul and the mandatory tenant insurance, which we talked about as well. Another big key, and probably the biggest determinant as to the profitability of a certain asset class, is the discrepancy between economic occupancy and physical occupancy. This is a terminology that may not be used in all the other asset classes, but it's particularly important for self-storage. So this is essentially the property may be 88% occupied, but if you look at the economics, the net value at the end of the day to the bottom line, it could be only 60% economically occupied. And this is a combination of low rental rates, complete mismanagement failure, whether it be that they're not delivering or if they're completely overpaid, for example. You can have concessions that are too high. Hey, move in, we'll give you 2 months free, and it's only $1 move-in fee and stuff like that. Prepaid discounts. You also have a lot of, with the mom and pops, especially employees paying for personal expenses out of the business. I mean, you'd be surprised how much we see. And then things like late fees and admin fees. Okay, yeah. I mean, it's shocking. I mean, I'll give you an example. That property I mentioned earlier with Fayetteville, we pulled up to conduct due diligence, and I was on an on-site property visit, and the manager was renting out a pair of scissors to the tenants that needed to cut boxes while they're moving in. Rather than sell the scissors, he was just had one pair. He's like, "Oh, I'll pull it out from under the desk," and that is like, obviously that's not that huge a deal. Probably about $100, and it probably should have been $120 or so. But the rental rate on the scissors.
Yeah. I was like, damn, that sounds pretty good, man. I'll rent some scissors.
That's a zero. Yeah, exactly. So, I mean, it's not a lot of money, whatever. They're probably missing up on $7 of revenue. But the key is that shows you the mindset of the manager, right? It's not operating like a business. Yep. So that discrepancy between the physical occupancy and the economic occupancy is probably the most important, especially when you consider the fact that the tenant base is really, really sticky. So you can implement those strategies very quickly. There's one of the other ones that is
sold, right?
Yeah, exactly. I'd say that one more to touch on. This is slightly more capital intensive, but identifying properties that don't offer or completely underserving the climate controlled units. So these are units that are typically 20 to 30% more expensive that regulate the climate within the unit. And this can be a really lucrative upsell once tenants are already on the property thinking that they're going to rent a property for $100 a month. And so we can buy properties and convert units to climate controlled units, or expand the property exclusively with climate controlled units if there's not enough units in the property.
You touched about economic and physical vacancy. We've been discussing that, Jake and I, over the last 6 months, and it's really prevalent in your Memphis market where you went to school and you lived. In multifamily, it is huge. I mean, they can show a 92% occupancy, but if you dig down deep and all of a sudden you start seeing, is everybody paying? And Memphis is notorious
what's up with
for
Memphis?
this.
Why aren't they paying in Memphis?
I mean, it's like you talk about like maybe a 10 or 15% difference, and it's like the pro forma looks great. But if these people ain't paying, and it's a lot different than your asset class, it takes a couple months to get all these people out and to get new people in. So it's for all you multifamily guys out there, there's a huge discrepancy in certain markets between people actually paying. And be careful, be wary that when somebody's selling an asset, they're going to throw warm bodies in there. So that's the other thing. If you see income going from $50,000 to $65,000 in 2 months, Look at those leases. Make sure that they're just not throwing people in there, and make sure that they're actually paying. So that's a really crucial point that you made. I want to backtrack and just ask you, how did you get into this niche? How did you educate yourself on it? And I mean, how did you find it? And I mean, how did you get where you are?
Yeah. So, when I first moved to California, again, the market had been completely just decimated, and a lot of people had lost their shirts because of the volatility in the market. And a lot of very experienced real estate investors that I had a lot of respect for had foreclosures on their record, et cetera. So I started going to seminars, trying to learn as much as I could. I've always been the kind of counter-cyclical, kind of contrarian type of guy. So when things are really gross, I usually kind of dive in. And so the timing just worked well for my personality, but it's just favorable market timing anyway. But going to those events originally was, it wasn't rah, here we are making cash. They were very small events. People were very somber, and they were basically trying to weather the storm. And I was introduced to kind of the right people at the right time, combination of just luck. But the reality was the only people that were still standing were some of the best in the business, because a lot of the weeds were just completely removed. So, going to events where there was 10 people speaking, 8 of which had been involved in $100 million of transactions, that was the situation. Mm-hmm. So just kind of pursuing that education. And to be honest, at the time, there wasn't as much content available on the internet. You could read, at the time, it was to buy CDs and books and tapes. But so things like what you guys are doing, holy crap, listening at home, hopefully, I know that you guys are putting out tons of content. The amount of the education level that you guys are doing and their listener base that you guys have is just, it was very different 7 years ago. So yeah, kudos to you guys, and thanks again for putting out the podcast that you guys do.
Thanks. You're scaling up. You started small. How are you starting to build your systems and your teams and getting to that next level?
Yeah, that's a good question. That's something that has really come up a lot recently, because it is working quite well. And I'm trying to look at ways to kind of take full advantage of that. So, at the end of the day, I don't know if this is directly an answer to your question, but this is what comes to mind. I have repeatedly found that being authentic in your message and being yourself is what's most powerful. So a friend of mine is a CEO of a very well-known company, a startup. And when he first went to raise money for the startup, he got no's by every single VC. 25 plus VCs said absolutely no to them. And he kind of went back and did some soul searching and realized that because of his background, which he didn't graduate from high school, he got a GED and then proceeded to start a company and then sell it. But the key is, when he was going to the VCs, a lot of these guys are Ivy League grads, a lot of Wharton business guys, and he was kind of hiding that. The key is that they knew he's hiding something, but they don't know what it is. And as soon as he started embracing that and saying, yeah, I'm Tweedledum over here, look at me, but look what I've done, the money just started flowing in, and they've raised more than $100 million for the VC firm. So I would say that, being authentic in your message. I have a podcast as well. That's always been my method of communication. I like talking. I like talking to smart people. I used to write blogs all day. None of them got traction. I'm not a very good writer. Why was I doing that? I was just trying to be like everyone else. So the more authentic I've been, and the more, tripling down on the strengths that I have, the few strengths that I have, the better things have gone. So that's kind of my answer there.
Let me ask you, what's the best real estate investing advice or tip that you have for the listeners?
Yeah, great question. I'd say number one, focus on education. Again, the content that you guys are putting out, the fact that I'm always looking for risk-adjusted returns. Educational content is by far the best way to get risk-adjusted returns. You're just not going to lose anything. I just read a recent book called 10X by Grant Cardone, which I'm sure some of you are familiar with. That's a no-brainer. Go knock it out in a few days. Things like that are definitely a good idea. And then recently, I had a guest on my podcast named Ethan Penner, who is credited with inventing the mortgage-backed securities space, commercial mortgage-backed securities, just a complete titan in the industry. And something he said, which is, it is not a race, and enjoy the journey as much as possible, because when you look back, you're going to really be happy with the ups and downs of your own personal life and business life. So those are some of the things that come to mind.
G-Dad.
J-Love.
Guess what?
What?
We are going to do a plug right now. You ready?
I was born ready. You know that, bro.
All right, so we're gonna do a plug because we just started using his service, okay? And we're gonna discuss that service, and that is CrowdStreet. And CrowdStreet believes that investors of all sizes should have access to quality commercial real estate investments. The CrowdStreet marketplace features vetted commercial real estate investment offerings from over 100 sponsors from across the U.S. Download a free copy of our commercial real estate investing guide at crowdstreet.com/wheelbarrow. But Gino, the question is, how long until we get our first deal on the CrowdStreet marketplace?
Jake, that's a great question. I'm going to ask you a question.
Oh shit! All right.
I want to ask you your take of this company. What do you think of this company? My answer is I love them. I want them to go to our podcast about 6 months ago we did with Darren Powderly.
Yep.
Go on there. He is so knowledgeable. He's the disruptor in the space, one of the disruptors in the space. Go listen to his podcast. Don't listen to our plug. We're only using and talking about this company because we love the company. Real easy to work with. They've got a terrific product. Go listen to that podcast.
So my thing is this. I'm just getting greedy. Like, I don't want to syndicate our deals because I want it all for myself, and I'm being a pig. But we could put some of the deals out there and open them up, but I'm just not ready to do that yet.
Well, it's a mind
That's the
shift.
question.
Like,
I know.
yeah,
I got to get there.
yeah.
You know, we got to let some guys in at some point. But I'm
Hunter's
I'm being a little bit of a
talking about
pig.
that. He's talking about that. They're on the podcast. It's all a mind shift. It's all about, let's get to this point. And the other thing is, it's very difficult. He's got a lot more meat on his bones on his deals. Our deals have been as rich in the last year and a half. So once we get a little more meat on the bone, we can start syndicating.
Turkey legs. So let's get back. Hunter, you've been growing your business. What is something that you do every day that's a great habit that you can say, hey, this worked for me, this helped me grow my business? It could be anything. What's a habit that you do on a daily basis that makes you great?
Yeah, I mean, first of all, I'm just constantly trying to find out new ways to do exactly what you just said. So the first thing that comes to mind is I have pretty much stopped answering non-extremely pertinent emails until 12. And the first thing, that's when my brain is the smartest in the morning. So I get up and I do at least 2 hours of content creation, just basically thinking about different ways to grow my business, thinking about systems I can put in place, writing down different ideas. And that has helped me tremendously. Plus, there's a lot of data that suggests that doing that actually makes you respond to emails faster because you bang them out all in one go. And that way you're not – another thing is that with doing that, you don't respond to emails in the morning, then respond to the person that responds to your emails at 12, and then respond to it's just this endless cycle of nonsense. So if you can just get up, and this is just what works for me, get up, do 2 hours of something specifically designed to grow your business and implement systems, the rest of the day is kind of secondary to that because that's the most important thing you can do.
You know what they call that?
What's
Give it
it called,
to me.
Jake?
Hit it and quit it.
Exactly. That's what I'm trying to implement.
Jake? It's called Miracle Morning. You got to read the book Miracle Morning by Hal Elrod and Cameron Herold. It's all about that. When you get up in the morning, and I know everyone's going to say, oh, I'm not a morning person. Well, I wasn't either. But if you can get up and spend that first hour, whether you're doing your incantations, your affirmations, you're doing a little bit of journaling, you're getting some exercise in, it'll motivate you. It'll energize you. Your whole being. You start out that morning fresh, and you'll just perform so much better throughout the day. So I totally agree with what you're saying. Totally.
Yeah, I love it. And I'll check that book out for sure.
It's awesome.
What's been your biggest mistake since you've been in the real estate game?
Yeah, that's a good question. I took a big bet on a operator that didn't really have any experience in a space and didn't really know what he was doing. And that operator was me. I invested in single family houses. When I was
like he's
investing in
tell
single
us who
family
it is.
houses. I'm going to blow the guy up on your podcast. That's what happened. I didn't have knowledge of the single family space. I certainly didn't have an upper hand. And it didn't, again, with being being authentic and being yourself, I have always found that my communication does better with very sophisticated individuals. This is why I like working in the price points of the $5 million and $15 million range, because I like talking to people that have that kind of background. My girlfriend, for example, she communicates very well with less sophisticated individuals. She's a very smart girl, went to Duke, et cetera, but that's kind of she has a very effective communication strategy with that class. So my point is, I wasn't being authentic to myself, and I was just trying to do what other people were doing. And, that's what led me down to the path of investing in $30,000 houses with property managers that are making $50 a month. I mean, who thought that was a good idea? I mean, I can't do it.
A lot of people think that's a good idea, apparently.
Yeah. It's the most
I don't know how
popular
that's working out for them,
real
but...
estate. Yep.
Well, it's unfortunate because the way the market is right now, those people are making out. So as they're going up, they're getting lucky. They're making money in spite of themselves. I just can't wait till that market turns, and they're all.
Gino, why be a hater? Come on now.
I'm not hating. I'm just saying that's what's going
on the single families, the SFRs. So, all right, you mentioned GC and the 10X rule. What's another book that has helped you along your journey that you'd like to throw out there?
Yeah, I mean, I got to throw out some of the famous ones, obviously. 4 Hour Workweek is a no-brainer. Rich Dad, Poor Dad, of course. Millionaire Real Estate Investor, obviously. But if you haven't read Pitch Anything, I think it's really good.
Class,
obviously,
is that it?
Exactly.
Yeah, dude's smart.
Exactly. Effectively communicating your ideas, whether you're trying to sell something or just influence, it's never going to be a bad idea to gain your ability to influence others, especially for the positive. 22 immutable laws of marketing, etc. I think the key, though, is just to absorb knowledge. Again, risk-adjusted basis, always good idea to focus on financial education in particular.
What's been your best deal and why?
Man, that deal in Fayetteville is going to be really up there. That was just a screamer, and it was just very low headache. The quarterly distributions were made on time, etc. I'd say that some investments I made in 2012 in the mobile home park space are going to end up being up there as well. Sometime in the future we can talk about mobile home parks. I have spent most of my career focusing on that asset class, and there was so much opportunity there. In that time, prices had depressed significantly. Again, very sticky tenant base, caters to the recession-resistant asset classes. And the company that we were investing with was earlier positioned to go public. Those things have changed in the public market, so they stopped. But we're probably going to be selling to a private equity firm here in not too long, which will be very favorable.
That's great. That's awesome. Congrats.
Thanks.
What is the best way for listeners to get a hold of you?
So they can go to cashflowconnections.com. Also, you can send me an email at any time, Hunter Thompson with a P, THOMPSON at cashflowconnections.com. Also, I've got a podcast, which if you guys are interested in syndications, I definitely think you should check it out. Some major heavy hitters have been guests on there, and that is the Cashflow Connections Real Estate Podcast, located on iTunes, Stitcher, SoundCloud. But iTunes is the preferred one because we want those subscriptions. Give me that subscription money.
Gino, why aren't we getting subscription money?
I don't know. That's a good question. It's another good question.
We got to talk after this. I didn't know we had subscription money. We got to talk about this. We got to monetize. What the hell are we doing, man? We just talked about this. We're 100 deep, and I don't get any subscription money. You holding out on me? Yeah. What are you doing, man? Come on, man.
Go put
it's the same thing as like
Come
YouTube
on.
money. Same thing as YouTube money. Like you get the views, you're like, oh, that's YouTube. I'm YouTube rich, but you didn't really make any money. But you got your name out there.
YouTube rich. I like it. Gino, you got anything else?
No. I think this is a great podcast. Self-storage, mobile home parks, apartments. They're all different niches, but they're sort of the same
There's
strategies.
so many similarities. Yeah, there's so many crossovers. Yeah. I'm sitting there, talk about these mom and pops, and I'm like, yep. Yeah.
And that's what it's all about. I think you really need to look for a motivated seller. I think everyone should read the book. I just finished reading the book by Jim Camp, Start With No. It's all about negotiations. And same thing with Never Split the Difference by Chris Voss. Those two, if you're in any type of real estate, those two books, you have to read them. I wish I'd read them sooner. Negotiations are like a dance. And he's got a great framework, Jim Camp, in the book. We're always afraid to hear the word no. Once you hear the word no, then it's go time. We always want to get that yes, yes, yes. So I think that's one of the things. But I like the niches. I like all of them, and I'm glad Hunter took out time out of his day to share his story with us because I think it's a great story. And I wish you all the luck, Hunter. Thanks.
Yeah, can't thank you enough, guys. Thanks again.
Thanks, Hunter.